The loss to investors is more than twice what we saw in 08-09. That's how bad this is. This is going to be quite a surprise to a number of investors. I think this is getting to be so serious that we are reaching a cathartic moment, and I do think it's started. We think this is a bit of a financial crisis.
Cathie Wood thinks that Jerome Powell is looking at all the wrong data and that the Federal Reserve is going to do serious damage to the economy as a result. While they're focused on stopping inflation, Cathie Wood believes that we're about to see massive deflation. Will the Fed change its mind? Or is Cathie Wood looking too far into the future for her funds to survive the present? Your time is valuable, so let's get right into it. I really believe in their long-term vision of the future, but there's no doubt that many of Cathie Wood's predictions haven't made it to the present, at least not yet. And when it comes to the stocks that she's putting in her funds, being too early can be just as dangerous as being wrong. As a result, ARK Invest's flagship innovation fund, ARK-K, is down by over 60% year to date and just made a new low this past month. With that said, Cathie Wood's predictions could come true sooner than you think. Cathie Wood spent the last couple months really laying into the Federal Reserve. In a recent tweet storm, she compared today's economy to the Roaring Twenties, which is where the world saw new game-changing innovations like the telephone, electricity, and the internal combustion engine. Now, in the 2020s, we have artificial intelligence, genomics, robotics, energy storage, and blockchain technology. But in the early 1920s, we also had World War I, the Spanish flu, and inflation touched 24%. All three of which were much more severe than today's Russia-Ukraine war, the pandemic, and our 8% inflation. In the same Twitter thread, Cathie Wood warned that if the Fed doesn't pivot, the setup will be more like 1929, which was the start of the Great Depression. The Fed raised rates in 1929 to squelch financial speculation, and then in 1930, Congress passed Smoot-Hawley, putting 50% plus tariffs on more than 20,000 goods and pushing the global economy into the Great Depression. Unfortunately, today has some echoes of the same. The Fed is ignoring deflationary signals, and the CHIPS Act could harm trade even more than we understand. The reason that Cathie Wood is comparing the CHIPS Act to those tariffs is because microchips are in virtually everything we use today. So raising their production costs effectively raises prices on all of the goods that they're in. But what about the deflationary signals that Cathie Wood is talking about? Aren't we still seeing inflation across the board? To answer that, let's turn to Cathie Wood's October episode of In the Know. I've cut her 40-minute episode down to just the few minutes that focus on what the Fed is missing and what she thinks comes next for the stock market. After that, we'll take a look at which stocks she bought inside her ARK Invest funds. Hold on to your stocks, this is a pretty spicy clip.
I'd like to build the case a little more here that the Fed is probably making a mistake. I say probably because I have to from a compliance point of view, but I really do believe the Fed is making a mistake. So we took a look at the data for the last month because the Fed is saying that it's data-driven. So if it's data-driven, let's do that. The used car price index is going to collapse here. Why? Well, many people bought cars during COVID because they wanted to avoid mass transit. And as I mentioned, used car prices were up 54% on a year-over-year basis at one point. Now they're flat to down. And now dealers who were paying too much for used cars are sitting on losses, and they are going to have to disgorge those inventories because inventories cost money to carry. This is going to be quite a surprise to a number of investors. What's another weak link in the United States? Well, this is becoming a big problem for certain sectors of the economy that are in the throes of disruption, both cyclical and secular. And I think the retail sector is one of those. We remain astonished at the inventory buildup taking place out there. Nike's inventories, well, first of all, its global sales were up 3% in this last quarter. Its North American inventories were up 68%. And the inventories in transit were up 85%. So you know what's going to happen. In order to clear the shelves, Nike is going to have to cut prices, and retailers will as well. And we believe this is just a microcosm of a much broader problem out there. And so we think this is a bit of a financial crisis, and we think we'll see it elsewhere as the Fed continues to raise interest rates, as it seems want to do. So let's go to the commodity prices. Again, data-driven Fed. Are you listening? So the gold price down 17%, copper down 30%, lumber down 73%. Think about that. Housing is collapsing. Iron ore down 45%. Infrastructure around the world has run into trouble, especially China. Corn down 17%. Silver down 29%. DRAM prices, which are chips, semiconductors, down 46%. The Baltic Freight Index down 48%. That's an indicator of supply chain issues. The Baltic Freight Dry Index, which is just for dry goods, down 65%. Oil down 29%. And many people have been dismissing these as saying, yeah, but that's, they went to sky high prices. They're still not down on a year-over-year basis. That's not true anymore. Gold is down 3%. Copper is down 17%. Lumber is down 28% on a year-over-year basis. I think this is getting to be so serious that we are reaching a cathartic moment, and I do think it started. In the U.S., among major employers, 300 have announced layoffs, and those layoffs, which are broad-based company layoffs, are up 68% year over year. So just taking the evidence and putting it together like this, there is a lot of data to be driving the Fed, which is what they say is happening, but we don't think it's happening. I just rattled off lots of examples. Markets are selling off across the board, and that's very unusual. It's associated with crises and more convincing evidence to us that the Fed is too tight and that it will pivot. And when it does, it will do so, we think, significantly. Now, first, it might simply be rhetoric, because they always like to tee us up for what the next moves are going to be. And we haven't heard that rhetoric yet, despite all the evidence I just shared with you. But that evidence I just shared with you tells us that the Fed is going to get the message loudly and clearly somehow. And it may not be showing through in the numbers they want to see, but it will. It will. They are huge lagging indicators. They're basing policy on lagging indicators, not what they're supposed to be doing. Anyway, if you take, in the US alone, if you take equities and bonds and look at what's happened since the peak, you will see that the loss to investors is more than twice what we saw in 08, 09. That's how bad this is. In our experience, innovation starts to outperform in the late stages of a bear market. Why does that happen? It happens because innovation is the new leadership. Innovation solves problems. Innovation solves the kinds of problems we have today: supply chain, food, energy shortages, think the genomic revolution, electric vehicles, and so forth. And so we believe that innovation should outperform if we're toward the end of this bear market. If the Fed's close to pivoting, even in its rhetoric, I think we are. There are all kinds of reasons out there, data-driven reasons. And so we hope the Fed is paying more attention to all of the data instead of just a selected few pieces of lagging indicators.